Hey everybody, Tim Albrecht here, and thank you for listening to the YFP podcast, where each week we strive to inspire and encourage you on your path towards achieving financial freedom. This week I had a chance to sit down with YFP co-founder and director of financial planning, Tim Baker, to talk about the three silent killers of your investment pie: taxes, inflation, and fees. Or easier way to remember, as Tim mentions on the show, is how to keep your investment portfolio fit by evaluating your fees, investments, and tax planning. A few of my favorite moments from the show include hearing Tim talk about common tax mistakes he sees pharmacists making and why he decided early on to bring a tax practice in-house with the financial planning services, why inflation is often overlooked but an important part of the financial plan to consider, and what the antidote to inflation is, why those nearing retirement should be looking closely at inflation and the volatility of the market, and finally, the common types of fees associated with the financial plan and why these fees can have such a large impact on your investment portfolio. Now, before we hear from today's sponsor and then jump into the show, I recognize that many listeners may not be aware of what the team at YFP Planning does in working one-on-one with more than 250 households in 40 plus states. YFP Planning offers fee-only, high-touch financial planning that is customized for the pharmacy professional. If you're interested in learning more about how working one-on-one with a certified financial planner may help you achieve your financial goals, you can book a free discovery call at yfpplanning.com. Whether or not YFP Planning's financial planning services are a good fit for you, know that we appreciate your support of this podcast and our mission to help pharmacists achieve financial freedom. Okay, let's hear from today's sponsor, Ensuring Income, and then we'll jump into my interview with Tim. This week's podcast episode is brought to you by Ensuring Income. Ensuring Income is your source for all things term life insurance and own occupation disability insurance. Ensuring Income has a relationship with America's top-rated term life insurance and disability insurance companies, so pharmacists like you can easily find the best solutions for your personal situation. To better serve you, Ensuring Income reviews all applicable carriers in the marketplace for your desired coverage, supports clients in all 50 states, and makes sure all of your questions get answered. To get quotes and apply for term life or disability insurance, see sample contracts from disability carriers, or learn more about these topics, visit insuringincome.com/your financial pharmacist. Again, that's insuringincome.com/your financial pharmacist. Tim, excited to have you back on the show.
Yeah, Tim, glad to be back. What's going on?
It's been an exciting start to the year.
Yes.
Lots of exciting things going on at YFP. We're heating up the season of some of the speaking engagements that we're doing for the year. Grateful for those opportunities. I think the team is humming and moving forward. So it's been a good first quarter of the year. And you've got an exciting trip coming up tomorrow. I think you're leaving, right? International?
Yeah, going international. My wife, Shay, shout out to her if she listens to the show, sometimes not, is running the Paris Marathon. So a couple of weeks ago, she actually had fractured her foot in a misstep. So she's been doing a lot of like cycling and pool work and things like that. So she got the news a couple of weeks ago that she could run again. And so she's rearing to go, heading out, and excited to visit Paris again. It'll be her first time, and just enjoy some one-on-one time without the kids. It'll be nice. I'm excited. I kind of feel like we've been so cooped up because of the pandemic. I haven't really been traveling as much. So yeah, I'm pumped up. And to go back to that thing, Tim, I was, shocked. I think when we actually sat down and you tallied up the reach that YFP has had over the last couple of years with, I think it was like 72 different schools and associations that we've kind of been, speaking with and, doing presentations and things like that. I think that was a little bit shocking to me, but awesome to kind of see that number and see it continue to grow.
Yeah, we're so grateful for that opportunity. We've partnered with just over 70 different organizations. It's been colleges of pharmacy, state associations, national associations, fellowship programs, residency programs, some of the businesses that are out there and entrepreneurs. So super grateful for that opportunity. And I think the reach that has allowed us to have as we look to help more and more pharmacists on their mission towards achieving financial freedom. So we're looking to grow in that list here. And if anyone is listening that, is looking to have a session on personal finance, financial education, we'd love to engage the YFP team, the YFP planning team. So you can reach out to us at info@yourfinancialpharmacist.com. Tim, today we're talking about silent killers to your investment pie. So we're talking about things like tax, inflation, fees. We've talked about these separately on the show, but I want to keep coming back to these and we're going to bring these together. We talk so often about the hard work of building your investment pie, right? Ultimately, we're going to be paying ourselves out a retirement paycheck. We've got to do the hard work to save early, to save often, take advantage of that time value of money. But we might be underestimating the impact these silent killers like tax, like inflation, like fees, that may not be as obvious or as front and center, but certainly can have an impact on our financial plan. And so we're going to go through these one by one in 3 parts. We'll start with the taxes. We'll then talk about inflation. We'll talk about fees. We'll reference previous episodes. We talked about these for folks that want to dig deeper in any one of these topics. And again, if you're going to do the hard work and you're going to build that investment pie, we want to do as much as we can to maintain the integrity. So Tim, let's start with tax season. Couldn't it be better timing? We're, about a half a month now away from the IRS tax deadline. The YFP tax team is knee deep in making sure we get the tax filing and returns, and a shout out to that team if they're listening to this episode. So here we are. It's front and center for lots of folks. Maybe they're looking at the returns that they filed and maybe they got it spot on. Maybe they saw opportunities to improve. Maybe they got a big refund or were surprised by a bill that was due. So just talk to us about why this topic of tax is so important.
Yeah, and I'm actually looking at the title of this. I see tax, inflation, and fees, and I think if we were to go to in reverse order, FIT, this is, I think, really about keeping your investment portfolio fit. And we'll go tax, inflation, fees as we talk here. And I think the reason we kick off with tax is because it just permeates everything, Tim. Like every conversation that we have related to the financial plan, there's a tax conversation close by, unfortunately. So, one of the numbers that's always sticks with me is that, we mentioned speaking, over the course of a pharmacist's career, they're going to make about $9 million. And the actual dollars that flow into the bank account is closer to $6 million. So that's alarming because you're like, all right, well, where's 30? Like, where's a good chunk of that go? And that 3 million, that delta, a lot of that is being soaked up by Uncle Sam, the tax man. And, what we see, related to tax is that there's typically a lot of dollars left on the table in terms of what you can do to mitigate the amount that the government is taking from you. And again, I think everyone wants to pay their fair share, but no one wants to overpay if they don't need to. So yeah, and I think for us as a group, I kind of harken back to the day when, when we were started, I launched Script Financial, now YFP Planning. And, I was even before that, in my first, job in financial planning, financial services, a lot of traditional financial planning firms do not do taxes. And, I found that to be very problematic, Tim, because again, I think they're just so closely aligned with what you're doing on the planning side that there needs to be some coordination on the tax side. So shortly after I launched Script Financial, we started to do taxes for our clients, and it's not a fun thing to do. The tax work, Tim, as we know right now, it can be hectic. You're trying to cram so much work in a small window of time, and it's like trying to manage a lot of projects on a tight deadline that you have inputs and outputs from a variety of people. However, the reason that we do it is because I think the value that it brings to the overall plan. And I'll give you some examples. So, when I would do, planning for pharmacists, one of the biggest thing, a lot of the pharmacists that we were working with, the tail that wags the dog are the student loans, right? So the student loans, one of the major strategies there is a forgiveness strategy, particularly PSLF or even non-PSLF. So because in that strategy, one of the main techniques you could do if you're married is to file separately to disallow the income of the spouse that doesn't have loans, and really just work off of the, the AGI and the student loan payment is off of one of the spouse versus two.
Right.
So the problem is this, Tim, and I say this is like, I would build out these dope, that's the official term, dope financial planning strategy related to the student loans. And then, the client would say, hey, Tim, do you guys do taxes? And we'd be like, nah, we don't, but, go work with this accountant across the street and, they'll hook you up. We like what they do. But the problem is that because most financial planners don't understand student loans. So I think the stat out there that I saw is that, 33% of financial planners will work with clients on their student loans. It doesn't mean they necessarily understand them, but they'll at least address them. That means the overwhelming majority don't even really look at it. So the problem is that because advisors don't understand student loans. Typically, the accountants that they work with don't understand it. And in 99 out of 100 times, for most people, filing anything but filing jointly for a married couple is wrong. But we just happen to work with a lot of pharmacists that it does make sense because of the huge benefit you get from maximizing the forgiveness. So I just kind of got fatigued by building out this great debt plan and then it being messed up by the lack of technical expertise on the tax side of things to see that through. And then I think like the other piece of this is we're planners, right? So like I want a plan. And I remember, again, back in the early days, I would hire, a tax person to do my own personal taxes. And I'm a business owner. So, and I got a good referral from someone and, I met with them. They're like, oh yeah, we'll be able to kind of like help diagnose some things with your business and all this. And I'm like, great, this sounds awesome. And then a couple of months roll around. I'm like, man, it's like April 14th. Like, where are my taxes? So I sent out an email and I get an email back and it's a PDF of the tax return, some DocuSigns to sign, and then an invoice. And I kind of equate, it's almost like a paper route, right? So it's like, here you go, chuck the paper out the window, you figure it out. And I just didn't like that because again, I was looking for things that, and I get it. Like I'm kind of a nerd like that. But again, as a business owner, I wanted to make sure like, am I doing everything to kind of mitigate my tax exposure? And I got zero guidance, zero planning, based on, planning advice based on last year's activities. And I really wanted that. And to me, I think there's a lot of people that want that and are trying to figure out ways to get in front of the tax man. And then finally, I think just, the reason that we did it is that, like I said before, is like, I think it's just a coordination of your financial plan. So it's not just the debt piece. We would work with clients in my last firm where there probably needed to be a healthy conversation regarding the investment portfolio that just wasn't had. And I understand, like, I get it. Like during tax season, it's really hectic. So you're just trying to like move the return through. But at the end of the day, the reason that we kind of, make sure that everything goes through the lead planner to the CFP, it's kind of a check to say, okay, does this jive with everything else that we're trying to do? Not this debt, but the investments and whatever else is kind of on the client's plate, just to make sure that there is a clear intention of, hey, this reporting period in Q1, all the way up to April 15th, this is really a reaction to what happened last year. But then what are the things that we can do, or what are the things that we learned from this year that we can apply to the present year, in this case, 2022. And I think if you stack, just like the financial plan, I think if you stack years of doing that, you really shrink that delta, that 9 million to 6. I think you really start to shrink that in terms of like what you're keeping in your pocket. And I think for most people out there, like that's worth the conversation and worth the planning.
Yeah, Tim, just to that point, that the delta is significant in and of itself, 9 million to 6 million. And you and I both agree, like taxes have value, right? They provide services we all appreciate. We want to pay our fair share. So it's not just the delta, but also, how can that delta be put to use?
Yeah, exactly.
What is the effect of that?
And I think that there's just a lot of, like, from things that we see with clients, there's just a lot of meat on the bone. There's a lot of opportunity to, hey, have you thought about this? Or, as an example, like HSAs, those are everyone, we talk about them a lot, but a lot of people don't necessarily fund them. Even like things related to children, like FSAs, particularly for dependent care, making sure money goes through there, education planning. Sometimes there's this singular focus on things like Roth IRA and conversions and backdoor and all that kind of stuff. And it's like, we shouldn't even be having this conversation yet. And I think some of it's like an overconfidence for the taxpayer of like what's important and what's not. We see a lot of things with taxable accounts, Robinhood, things like that, where there's a focus there that really shouldn't be, or disallowed losses due to, wash sale rolls or things like that we've seen. Lack of record keeping for side hustles, as we're talking about, like Schedule C income expenses, lack of coordination for charitable giving. So with the larger deduction these days, there's a bunch strategy where you should be bunching your charitable giving versus doing it consistent year over year. With cryptocurrency, we could have a whole thing on that, Tim, cryptocurrency. And then just kind of the overlay of, hey, there's a huge refund or a huge tax bill that I think sometimes is due to either a lack of planning or a lack of follow through on the planning, or just an understanding of how withholding or the W-4 works. So, and I think this is a sample of things, of what we see. And I think, again, if you can start to work through some of those issues, Tim, I think you start to see, and again, it's hard to like quantify year over year, but these are just little tweaks here that I think, we talk about the investment portfolio kind of being like a rocket ship, and sometimes like fees and things like that is drag on that. And I think the same thing could be, the case with taxes and your net worth, your financial plan.
Yeah, it's great stuff. And the compound effect of those changes, I think about someone who unlocks, things like the HSA, or, is able to really look at some of the bunching strategies or other things that you mentioned, dependent care FSAs, et cetera, or priority of investment, and making sure we've got that right. It's not only getting that advice, recommendation, a strategy put in place today, but what does that mean, going forward, in the compound effect of that? We talked about lots of that. We had our director of tax, Paul Eichenberg, on episode 233. We'll link to that in the show notes. We talked about some of the common tax strategies, tax mistakes that pharmacists should be thinking about. And I'm glad you brought up the student loans to kick off that conversation. Just last week, we had 3 PSLF success stories. And through those stories, we heard about some of the optimization strategies. And of course, one of that would be the filing status, which folks may mess up if they're not getting good advice there. Tim, one of the things I'm really excited about, and shout out again to the tax team that's been hustling this season, is you and I think are really behind this vision and approach of, yeah, we got to file, the IRS says we have to do it, or else they're going to come knocking at our door. And that's great. And we're going to keep doing that. But we're going to do that really if it's a part of the planning and the strategy. And so you gave that story of April 14th, here's the DocuSign, sign it, here's your bill. That's great. I mean, that's stuff that's been done. It's in our rearview mirror. Let's talk about what we can do going forward to really optimize, the plan, and perhaps avoid some of the mistakes that were made throughout the year. And so, we're excited about really shifting away from, just that filing to more of that year-round planning, that strategy, that mid-year projection, that pivot. How do we really optimize this with the financial plan? And while this tax season, we've closed the doors in terms of, new folks that we're going to be doing tax returns. Again, we've only got about 15 days, a couple weeks left in the season. We are going to start to build out a list of folks that are interested in more of that year-round planning optimization. And you can go to yourfinancialpharmacist.com/tax and get more information there.
Yeah. And I think the other thing to take into consideration here is right now we talk a lot about the accumulation of the portfolio and how taxes is related to that. I think the other thing is really looking at the withdrawal.
Mm-hmm.
When you're a pre-retiree, and again, simple, if you have $1 million in your traditional 401k, $1 million say in a Roth IRA, and $1 million in a taxable account, unfortunately, all of those dollars are not yours, particularly the traditional. Uncle Sam still has to take the bite of the apple. But one of the main things that we look at when we're trying to structure a paycheck that is going to be able to sustain that retiree for the course of their lives is the tax, and minimizing the tax burden, and how we kind of draw on each type of account and the best strategy for it. A lot of that is a tax conversation. So to me, it's something that I think it permeates every part of the financial plan, right, but it's also every stage of life. So, there's even conversations of like, okay, how do we structure how much in this bucket or this bucket as we are accumulating to kind of get in front of that when we are starting to say, okay, I'm 65, I'm retired, we're going to use 30 years I'm going to live to 95 just to, model this out. Like, how do I draw from each bucket and overlay things like Social Security and everything else to make sure that the biggest, I think, stressor for a retiree is, am I going to have enough money? Like, is the money going to run out? And I don't want to be destitute or have to rely on family. So it's really trying to, and again, if we can hold on to more of those dollars that still have to, be taxed or take those monies, when you're in a lower tax bracket or whatever that is, it's really important to have that coordination. And it's a frequent conversation. It's not just, hey, April 15th come and gone. It's something that we continually look at and make sure we're on top of.
Well, thanks for being a wet blanket, Tim, that if I've saved $1 million, I might actually not have $1 million. So good point.
Yeah, sorry about that.
So that's a good summary of taxes. We're going to keep coming back to this topic. So important for all the reasons we mentioned. Moving on to the second one, as you mentioned in this concept of making sure an investment portfolios fit, the I being inflation. And so, I think normally we talk about inflation and it's like, whatever. And especially for folks that, are in the first half of their career, like, we have not seen inflation at the rate that we are seeing it right now.
Yeah.
And certainly it has been higher than that historically, but it's well above what we had expected to be on an annual rate. And so we've got, as of January, if you look at the yearly rate, we're hovering around 7%. We talked about this in episode 239, two financial eyes you might be overlooking, inflation, I bonds. We'll link to that in the show notes. Since that episode, I would say this has been exacerbated by the unfortunate situation in Ukraine. We see oil prices going up. We see the market volatility that's happening. Tim, we know inflation is real. We're feeling it in the moment. Jess and I were just talking about this in terms of month to month, what this is playing out to be in terms of expenses, but still hard, I think, sometimes to put our finger on it and the impact it can have on the plan. Why is that? And why is this so important as we think about the integrity of our investment pie?
Yeah, I think inflation is really one of the main reasons why we need to invest. So, I kind of say that if you're looking at the markets, and right now the markets are very volatile, up and down, negative in some cases, like, what you feel is that you want to take your investment ball and go home. You're like, what, I can't take the swings, Tim. Like,
I'm feeling it right now. I'm not going to lie, Tim.
Yeah, I don't like looking at my accounts and seeing X, and then the next day and seeing X minus 10%, 20%, 30% if we have a major correction. And I get it, and I think if you're 20, 30 years from your retirement date, if that's the purpose of your portfolio, I think you really have to train your heart and your mind to be like, okay, it's going to come back. Let's not worry about it now. I mean, if you're in retirement now and you're relying on that, and we don't have a good bucketing strategy or what have you to kind of sustain those losses, then I think it's more problematic. But yeah, you can't, I think what you can't do is just not participate. I don't think you can stuff your mattress and hope one day you wake up and you're going to have enough to retire. So I think the inflation piece is one of the main reasons why we need to invest. So one of the examples I give is that, that $4 latte that you buy at your local coffee shop, in 2020, if you use historical rates of inflation over the next 30 years, 2050, that same latte will cost $10. So, but I don't know if that's a good enough example, Tim. So, let's put it another way. If you make $120,000 as a pharmacist today, and we fast forward 30 years, and we're using historical rates of inflation, which is typically most planners are using about 3%, which we know like this year is high. That's it's low because we're seeing 7+. So 120,000 today as a pharmacist, in 30 years, that would be equivalent to 291,000. So think about that. 120,000 today would be equivalent to 291,000 in 30 years. So from a planning perspective, if we're trying to build out a portfolio that can generate a paycheck that is some discount at that 291, because we know that Social Security is going to be there. It's going to be limited than what it is today. So we can take a little bit off for that. And then you're probably not saving, some of that 291 would go to retirement savings. But if you're going into retirement, you're not going to be saving for retirement. So there's some discount to that. But the idea is that, let's say it's 200,000, or let's say it's 180,000, whatever the case is, we have to be able to build a sustainable portfolio. So then, Tim, if you're my client at 65, 30 years from now, or whatever the number is, you're going to say, hey, where's my 200,000? At 66, hey, where's my 200,000? All the way up until 95 or whatever we're planning as, nobody knows when they're going to pass away. So that is really important because the investments, particularly in equity portfolio in your accumulation phase is going to be really important, for you to kind of stay in front of inflation and the tax man, quite frankly. So yeah. And just to back up, we kind of talked about this in the two eyes. When we talk inflation, inflation is the decline of purchasing power of a given currency over time. So what it basically means is that a basket of selected goods and services in the economy will increase over a period of time. And sometimes that is due because the economy, the government is printing money, which is certainly true in our case. We talked about quantitative easing and things like that. It could also be supply and demand. So one of the things that you didn't mention outside of the Ukraine crisis is, all of the boats that are at the port of LA or that are still need to be unloaded because of pandemic or whatever, like that's causing, a lack of the supply and demand, making prices go up. So, I think it's really important that, we understand those dynamics and know that we're not always going to be in a low inflation environment. It can go up like it has this year because of, X, Y, or Z. Even back, if you look back in the 80s, in the early 80s, inflation was 13.5%. And mortgage rates as a result were close to 17%. If we think about, we know rates are going up now, there's been a steep decline. And I think the government is trying to do what they can. But, the fact is we have printed a lot of money in the past, and that could rear its ugly head. So I think the way that we can mitigate the impact of inflation is really to invest in equity stocks and hold it over a long period of time, Tim. We know that, we're talking about 20 plus years. We know that the stock market is fairly predictable. So, typically over a 20-year period, the stock market will return about 10%, on average. And if we adjust that down for inflation, that's 7. So this year, that might not do a whole lot for you because that's the rate of inflation. So you're kind of breaking even at that point. But to me, it's really important to understand that how inflation can play a role in your ability to sustain yourself in the future. And again, we're feeling the pinch now because inflation has gone up so high and so much in a kind of a shorter period of time, where we're starting to really notice. And Tim, I'm sure, with Fort Boys, you're noticing it with like your fuel, your food bill, or even like we're seeing it at the pump, So, and those are things that, we're seeing it with housing prices, right? So those are things that get our attention, but we're probably not thinking about how this affects us in 10 years, 20 years, 30 years, depending on your timeline, for retirement.
Yeah. And as a shout out to your 76ers, like you got to trust the process. Right? So, like when you say investing is kind of the antidote to inflation, like a lot of people hear that in the moment, they see the volatility and they're like, it's the opposite of what I'm thinking. Right. So we've got to zoom out. And I think this is where the power of accountability and a coach and having that long view is so valuable. Tim, I'm also thinking about the folks that are listening that are like, hey, I'm nearing retirement, or, I thought I was going to make that decision here in the next year or so. And here we are when I'm going to be going into retirement in a high inflation period. I'm going into retirement while there's also a lot of volatility in the market. Like, just talk to us for a moment and another episode for another day about timing of that decision of retirement when we start to draw from our portfolios, and how in a high inflation period and a high volatility period could have an impact on that.
Yeah, it's probably so what we're talking about here is sequence risk. So sequence risk is essentially where what you've accumulated over the course of your career takes a hit. We're talking 20, 30%, which could be very well be on the horizon for us in terms of a correction of the market. And so, now we'll use $1 million. Let's say your portfolio was $1 million and then it bottoms out to 700,000, but then you're also taking $80,000 a year or whatever the number is. Right. So, in 2 years, in 3 years, you could see where your portfolio is almost half of what it was when you actually went to retire. And you're like, well, I had, $1 million and now I have $560,000 or whatever the number is. That's where you really see a higher rate of failure to the portfolio. Failure meaning that the money runs out, that balance goes to zero before you reach your, kind of end of plan year, which, a lot of people use, 30 years. So if you retire at 65, 95. So it's the combination of, the portfolio being down and then drawing down the portfolio at the same time. You almost can't make it up. And I have a little bit of experience that's just kind of in proxy. I remember my first job out of the military was with Sears Kmart. And I actually I was a trainee for my first year. And then I took over for a lady that retired. And this was right around like 08, 09. And that's when the market just completely got, the market was just completely down, and because of the subprime mortgage crisis. And I think she actually had to go back to work because her portfolio took a beating, and then she was actually drawing on it. So she kind of quickly realized that she needed to, not draw on that portfolio. So really, in these periods of time, right leading up, you could probably say about 5 to 10 years before retirement, maybe even 5 to 10 years after retirement, that's where you need to be the most conservative. It's kind of the eye of the storm. Yeah. And then for some people, it makes a heck of a lot of sense not to retire, then and try to, push it off. And sometimes that's unavoidable. Something like 40% of people retire sooner than they think, either because of illness for themselves or for a family member, or it could even be, being pushed out of the workforce. So sometimes it's out of your control. But when you overlay these decisions with things like Social Security, when to claim that and all that, it's super important. So, you could do everything correct for 30 years leading up to retirement, and then those first couple years in retirement be, kind of blow up your plan completely.
Yeah.
So that's sequence risk at its finest.
And we're going to come back to some more episodes we have planned out on building that retirement paycheck and that consideration as you're making that transition from all the hard work you've done and now making sure we're able to sustain that. So we've talked about taxes, we've talked about inflation, certainly not least, but last on our list is fees. And we know that fees can have a major impact on how much wealth one is able to build, and something that many folks may not realize of how big that implication can be. And we went into detail about fees on episode 208 on why minimizing fees on your investments is so important. We'll link to that in the show notes. So Tim, summary here of fees, something that we harp on over and over again, that folks may not be aware of those fees, often are not as transparent as perhaps we'd like them to be. And so as we continue this theme of some of these silent killers of the investment pie, talk to us about fees.
Yeah. So, there's no such thing as a free lunch, right, Tim? So there's when you're investing, or if you're working with an advisor, there's typically cost associated with that. I think the thing that I think bothers me as an advisor, but then also as a consumer, is the lack of transparency, right? So we know even in healthcare, there's people get upset about, well, what is the actual price? Or even, we talk about like PBMs and things like that. I think a lot of it comes down to like transparency and, what's going on, behind closed doors. So to me, and we see this a lot. And actually, when we have clients or prospective clients book time with us to see if they would be a good fit, we've added a button that they can upload a statement so we can kind of talk at a high level, if they're working with an advisor, what they're actually paying. Because most people, they either have the notion of, I'm not paying anything, which that's actually a common belief, or they know that they're paying something that just have no idea. And often is the case that they're paying a lot more than what they think. And I always go back to the story. I remember, so my first job out of the military was Sears. And then I had another job with a construction company. And I was like, you know what? I want to do something completely different, kind of go into a new industry. And I was like, hey, Mom, I think I'm going to become a financial planner. And I think verbatim, she said to me, "Is like, that's the dumbest idea I've ever heard." And I'm like, "What? Why?" And she's like, "Well, we work with this as an advisor, and we don't pay them anything." And I'm like, that can't actually be true. And, years later, when I kind of understood the landscape a little bit, I actually, peeled back the onion, and they were paying over $8,000 in fees, unbeknownst to them, So to me, I think fees aren't necessarily a bad thing. I think it's the transparency around that, that I think needs a lot of work. So really the fees that we're talking about here, Tim, that are most common are things like advisor compensation. Mm-hmm. And these are things, that you would, these are fees that you would pay, or commissions that you would pay to an advisor to, either provide financial planning or investment advice to you. So, one of the more common things that we see is an assets under management fee. So this is like, hey, Tim, you have $500,000 that I'll manage for you. I'll charge you 1%, and the fees $5,000, and I'll bill that right out of your investment accounts. That's very common. And to be honest, that's one of the reasons, that pricing structure is one of the reasons why, when we do find, younger pharmacists that are working with advisors, so they'll either be shut out, meaning like the advisor would say, hey, young pharmacist, I would love to be able to help you, but I can't. And it's not really because they can't, it's because they don't have those assets for you to manage that, and charge that 1%. So they're either shut out of the market, or they're sold, I would say, less than suitable products so they can make a commission and do some work with them, and they kind of wait for the assets to build over time. So this is where, if you're out there and you were in pharmacy school, or shortly thereafter, someone tried to sell you a life insurance policy, a disability policy, those are the next best thing for a lot of advisors. They can earn a commission, air quote, help the client, and then, stay in touch with them until they're ready, they have some assets for them to manage. It could be the same things like, oh, well, we'll invest your Roth IRA and we'll sell you an A share mutual. I was looking at a statement where there's both an AUM fee, but then A share. So an A share mutual fund is a front loaded commission. So, you pay 5.25% on that, and the advisor gets the commission and goes from there. So, but there's lots of other fees there, Tim, related to advisors, hourly, flat fee. There could be a hybrid, unrelated to the investment portfolio, but still in mix. There are things like life insurance commissions, disability, annuities. We recently saw a non-traded REIT, which is really sweet for the advisor because that's sometimes, 6, 7, 8% in terms of commissions. So that's a big piece. And I think a lot of people are kind of unaware of like what they're actually paying, and the transparency is a real thing that needs to be overcome.
Great summary. And again, we'll link back to episode 208, why minimizing fees on your investments is so important. And, I think the transparency is one piece, Tim, as you mentioned. Also just the tendency we have to underestimate the impact of something like 0.1, 0.2, 0.3, right? As we look at investments.
Absolutely. And I think if you're not working with an advisor, there are other things that are present. Probably the biggest one is expense ratio, Tim. So, and Justin Justin was our director of business development, working with another advisor for years before he came on to YFP. His portfolio, his all-in expense ratio was almost 1%, 0.91 to be exact. So what the expense ratio is, it's what the fund takes. So if you have ABC Mutual Fund that's managing billions of dollars, they might take 0.91% to pay for the mutual fund manager, the analyst, the fancy office on Wall Street, pay for information. So they do that to keep the lights on. And you basically buy that to get exposure to lots of different stocks and bonds, because that's what a mutual fund is, or an ETF. But 0.91% on a $100,000 portfolio is $910 per year. Whereas if you do something like YFP portfolios 0.05. So why would I pay $1,000 if I could pay $50 and have similar results and things like that? But so that the expense ratio is a huge one. Platform fees. So like when I was in the broker dealer world, we would charge $50 or whatever just to have an IRA open. There's things like annual account fees, closing account fees, retirement, especially in a low interest rate environment, like you're just trying to eke out fees because you can't make money on the float. But things like trading costs, all of these things add up. And again, this can just be drag on a portfolio. So those are the four big ones I would say is advisor compensation, trading costs, platform fees, and then internal to the funds that you're in, expense ratio. So what we try to say to clients is like, we try to minimize those as best we can, because at the end of the day, we want that portfolio to grow uninhibited as best we can. So, no such thing as a free lunch.
Yeah. And if folks are going to pay for, an advising fee, and we're not shy about, the fees that we charge and the value they bring, the point being is you want the value to bring, right? So, as you look at the coaching, the accountability, the holistic nature of comprehensive financial planning, like, there's a fee there and it's transparent. You want to understand it. You want to feel good that there's a return on the investment. So what we're talking, I think, about in terms of minimizing other fees are fees that maybe don't add value or that are not transparent. And so really evaluating closely the impact that those can have on your overall investment pie. And I'm going to link to a blog post from way back when that I wrote, where I looked at two different individuals that were saving about $1,000 per month between the ages of 30 and 65. And because of some of the difference in fees and things like expense ratios or other hidden fees, they ended up with a nest egg that was about $1 million difference. So again, the impact that we can see over the long run and what those fees can have. For folks that want to learn more about the financial planning services that are offered by the team at YFP Planning, perhaps you're working with a planner and interested in a second opinion, want to have an analysis of that statement just to get some different thoughts as well. Or if you haven't worked with a planner, we'd love to have a conversation as well. Folks can book a discovery call to learn to see if that's a good fit with our Director of Business Development, Justin Woods, also a pharmacist, and you can do that by visiting yfpplanning.com. Tim Baker, as always, great stuff, and wishing you and Shay the best as you get ready for your trip to Paris.
Yeah, thank you, my friend. Good to be on the episode here, and I think some good stuff to chat about it, probably even expand on in future episodes. So yeah, appreciate you having me back on.
Before we wrap up today's show, let's hear an important message from our sponsor, Insuring Income. If you are in the market to add own occupation disability insurance, term life insurance, or both, Insuring Income would love to be your resource. Insuring Income has relationships with all of the high-quality disability insurance and life insurance carriers you should be considering and can help you design coverage to best protect you and your family. Head over to insuringincome.com/your financial pharmacist or click on their link in the show notes to request quotes, ask a question, or start down your own path of learning more about this necessary protection. As we conclude this week's podcast, an important reminder that the content on this show is provided to you for informational purposes only and is not intended to provide and should not be relied on for investment or any other advice. Information in the podcast and corresponding materials should not be construed as a solicitation or offer to buy or sell any investment or related financial products. We urge listeners to consult with a financial advisor with respect to any investment. Furthermore, the information contained in our archived newsletters, blog posts, and podcasts is not updated and may not be accurate at the time you listen to it on the podcast. Opinions and analyses expressed herein are solely those of your financial pharmacist unless otherwise noted, and constitute judgments as of the dates published. Such information may contain forward-looking statements which are not intended to be guarantees of future events. Actual results could differ materially from those anticipated in the forward-looking statements. For more information, please visit yourfinancialpharmacist.com/disclaimer. Thank you again for your support of the Your Financial Pharmacist podcast. Have a great rest of your week.